Good morning. These are the things that matter most in Europe's market today. The AI trade is no longer being rewarded automatically, oil risk is back on the screen, luxury has to prove that demand is recovering, and one less obvious story is moving from equity volatility into bank risk plumbing. The central question for private investors is simple: is Europe opening into a normal rotation, or into a proof-driven tape where balance sheet quality matters more than theme labels? First, the AI spending story is becoming a European proof test. Big technology companies are still doubling down on data centers and chips, but investors are asking how much free cash flow they are willing to give up. Asian technology shares extended the sell-off overnight, SK Hynix fell despite strong growth, and the pressure around semiconductors is now a direct Europe issue. ASML is the cleanest read-through because the market is asking whether China competition and customer spending discipline can change the equipment cycle. SAP also matters because software investors want evidence that AI improves cloud growth without destroying margins. Infineon and STMicro are the broader cyclicals in the chain. The cleaner side of this story is companies that can show pricing power, contracted demand, or infrastructure bottlenecks. Pressure sits with chip equipment, semiconductor, and software names where expectations were built on perfect AI execution. For private investors, the practical takeaway is not that AI is over. It is that the market is forcing the theme to earn its valuation stock by stock. Second, all risk is back as a Europe inflation and margin test. CNBC reported renewed US-Iran strikes and a jump in oil, while MarketWatch highlighted Saudi Arabia using a more expensive export workaround. For Europe, this matters because energy is never only an energy sector story. Shell, BP, and TotalEnergies can benefit if crude stays firm, but airlines, chemical companies, and energy-intensive industrials face the other side of the same move. Ryanair, IAG, Lufthansa, BASF, and Covstro are the confirmation map. Potential beneficiaries are the large integrated energy companies and selected service names. Pressure is more visible in airlines, chemicals, and consumer-sensitive transport if fuel costs rise faster than demand. In plain English, the takeaway for private investors is this: oil strength can lift one part of the index while quietly taxing another. The useful question is which side actually leads the European tape today. Third, luxury has a selective recovery problem. LVMH's fashion and leather goods growth was not enough to satisfy investors, and that matters because luxury has been one of Europe's clearest global consumer signals. If the market treats the miss as company-specific, the damage can stay contained. If it treats the result as evidence that aspirational demand and China-linked spending are still weak, the pressure can spread across Hermès, Kering, Richemont, and premium suppliers. The stronger side is the highest quality brands with pricing power, clean inventory, and resilient customers. Pressure sits with turnaround stories and brands that need a faster China or US consumer recovery to justify expectations. The private investor filter is to separate brand quality from earnings momentum. A great franchise can still have a difficult trading day if the numbers do not confirm the story. The underappreciated story is not another headline about chips. It is market plumbing. The Financial Times reported that the Bank of England is probing Asian equity risk at prime brokers, and that hedge funds are facing larger collateral demands after AI stock losses. That sounds technical, but it matters for Europe because banks, brokers, and private credit markets can transmit equity volatility into funding conditions. If collateral becomes more expensive, risk appetite can tighten even when the main equity index looks calm. The cleaner side is well-capitalized banks with diversified revenue and careful counterparty exposure. Pressure sits with highly leveraged strategies, crowded growth trades, and lenders most exposed to market financing stress. For private investors, the takeaway is that volatility becomes more serious when it moves from share prices into financing terms. This is the one story today that could matter more than its headline size suggests. Here is the stock-led watch list. ASML, SAP, and Infineon. Does the AI reset stay contained, or does it become a broader European growth stock derating? Shell, BP, and TotalEnergies. Does oil strength lead, or do airlines and chemicals absorb the pressure instead? LVMH, Hermès, and Kering. Is luxury weakness company-specific or a sector signal? Deutsche Bank, UBS and BNP Paribas. Does market plumbing risk remain background noise, or does it change bank sentiment? Market bias, selective, defensive and proof-driven. Europe can still find winners, but the tape is unlikely to reward broad themes without confirmation from earnings, margins or balance sheet resilience. The mistake to avoid is treating every important macro story as an immediate trade signal. Today, the better filter is confirmation, which baskets validate the story, and which ones refuse to move. That is the Europe Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice.